So, so I'll just share my screen and go from there. So let's go back. Right, here we go. So firstly, thank you very much, obviously, for both of you coming along. It's always good to sort of talk about these sorts of things. Um, Now, what I do, obviously, I do a lot around, as Joe knows, but I do a lot around business development and that kind of thing. And basically supporting businesses in and business owners in what they do. Now, a common problem that a lot of business owners experience is really that with cash flow. So cash flow is a major, major challenge. You can be really profitable running a business, but actually, if you don't have cash in the bank when it comes to paying people, paying suppliers, paying the tax man and everything else, and also paying yourself, sometimes there's a struggle. So money is the thing that keeps people awake at night. It can have a profound effect on your business and your mental health. To give you, I'm very transparent, I'm very open and honest. And I was running a business in 2000 and I was the managing director of a business in 2008 to 2012. And unfortunately, the recession took the business. But during that time, my mental health massively struggled. And a lot of it was down to cash flow. We were actually profitable, but managing the cash was an absolute headache. So it's really, I wish I'd known some of these things that I know now that I'm going to talk to you today about back then, because it would have helped massively. So the big question a lot of business owners ask is how can we mitigate that sort of cash flow shortage? So what we're going to do today is going to be looking at three main areas. And if done properly, and if you do all three of these things, it will help you manage the cash within your business much, much easier. So the first thing we're going to look at is cash flow forecasting. Now, obviously, I'm going to be doing this is a very quick stop finish because cash flow forecasting, I literally talked to you for about 4 or 5 hours on this. I am that interesting person, but basically a cash flow forecast really is the prediction of money, the amount of money a business expects to receive and pay out over a given period of time. So it's a really, really vital tool for businesses to ensure they've got enough cash in the business. They can meet their cash obligations, and they've got enough cash to turn things to sort of manage the business properly and everything else. Now, I genuinely believe that a cash flow forecast is probably the single most useful tool that you can have when running a business. It really, really, if done properly, it just takes away making decisions by gut and actually gives you a very quantitative way of making decisions. The second thing I'm going to look at is credit control. A credit control policy is essentially a process that helps you manage the risk of extending credit to customers and ensuring that they pay on time. And again, the number of people that offer credit to their clients but don't actually have a credit control policy in place, and it ends up giving them huge issues and huge challenges is quite astonishing. However, both of these things are useless if you are not operating a cash management system. Excuse me. So a cash management system really it comes down to the monitoring and the maintaining of cash flow to ensure that business has enough funds to function. Not looking at your bank and seeing you've got £10,000 in the bank and you've not allocated that money properly and everything else, it can cause you huge problems. So a good cash flow management system or cash management system is really, really important to have. So what I'm going to do is going to just look at each of those in a little bit more depth. So a cash flow forecasting has got a number of major benefits to start off with. And like I say, it allows you to manage the incomings and outgoings of your business and how much money you're going to have in the business in future. So the first thing is it allows you to see when cash shortages are likely to be occurring. It gives you the ability to act early to avoid those cash shortages. You can advise suppliers, you can reduce hours for employees and things like that. And if it's done properly, you can actually see when that's going to happen. You can even see well in advance, 6 months in advance. If you're doing your forecasting correctly, you can see well in advance. And it's not a case of waking up in the morning, opening your bank account and seeing what you don't have there. So that's one of those things. The second thing is it effectively proves affordability for funding. So if you're looking to get some kind of funding into the business, if you're looking for a grant, or if you're looking to get some money into the business somehow, and you're looking for a lender to do that, or even an investor to do that, it shows you how you can arrange that funding so it's affordable, and people can see that the funding is going to be affordable to you. And the only way they do that is through a cash flow forecast. The third thing is, if you've got excess cash within the business, it shows you how and when you can use that cash. So, for example, if you're a seasonal business, you can see when you're going to have your peak times and when you're going to have your troughs, and how you can try and smooth those troughs out. I'll give you an example. I've got a client that I'm working with down here, and what she runs a restaurant, and it's a very seasonal business. And actually, she's just been through her very, very busy period. Obviously, being in a holiday location particularly during the school holidays, she's very, very busy. However, she's coming into her quiet period, which starts typically around about November and goes through to February. So it's about how she manages that cash through that. And I'll give you another example of what she's going to be doing. So she's looking at investing in marketing to increase the takeaway side of the business, because the local people tend to use the takeaways and tend not to go out to eat. So she's going to be marketing hard to try and reduce that trough and use the excess cash that she's got to build up the takeaway side of the business, so she doesn't see as much of a slump in her quieter periods. But you can use it for things like, if you're looking to buy equipment, if you've got excess cash, you can see how that's going to impact. A lot of people who are buying capital equipment will be spending tens of thousands of pounds on that equipment and buying it through loans, and it allows them to see how they can afford that loan and the affordability of something. So again, it takes away the guesswork out of doing it. Another benefit to it is, if you've got a payment issue from one of your clients, you can factor that into your cash flow forecast as well. So if you've got a client that says to you, they owe you a few £1,000s or whatever, and they're not going to be paying you when they say they're going to be paying you when you expect the money in, what you can do is you can come to an arrangement with them where they can pay that over a period of time, and you can plug those numbers into your cash flow forecast, and you can then see how that's going to impact. And if you're getting impacted like that, it might impact how you pay your suppliers. So again, if you have a supplier who you're going to be owing money to, and you can't afford to pay it because money isn't coming into your business as quickly as it potentially could be, then again, that's another way that you can factor that in. So it ensures that you keep your suppliers happy as well. Again, another practical example of this is, we used to work with a company who were a client of ours, and every time they had a VAT quarter, they would have a huge VAT quarter. It would be somewhere in the region of about £30,000. And generally speaking, they would say to us, they would usually pay us bang on the 10th of the month every month, except when they had a VAT quarter, and they'd say to us, look, we're going to need to extend it to probably the 20th of the month. But we knew about it, so that made life a lot easier. Like I mentioned earlier about seasonality, it does help you to predict the seasonality within your business as well. So again, if you know where those peaks and those troughs are coming in, and you know when is a good time to invest. So if you know you've got a quiet time coming up, but you have a cash surplus, what you can do is you can invest in your marketing, and you can invest in your business development, because you need to fill that quiet time with what you're trying to do. And that's a massive, massive bonus that you can do with it. However, for me, this is the big one. It helps you address the what ifs. So what if I want to purchase that course that I want to do? What if I want to purchase that car? What if I want to purchase that van? What if I want to introduce a new salary scheme, offer pay rises? What if I want to launch a new product? What if I want to open a new office? What if I want to pay myself dividends? All of these things that you use, you can stick into a cash flow forecast, and it will answer those questions. And I'll explain when we show the cash flow forecast, I'll explain how you do that and how that looks. But actually, the what if scenario is the real benefit to a cash flow forecast, because it allows you to just see what will happen. What if that client doesn't pay me, for example? So there are a number of pitfalls with a cash flow forecast. So if you don't do a cash flow forecast properly, and if you're over optimistic on your sales, what will end up happening is your cash flow forecast will look absolutely amazing, but it's not realistic, because if you think you're going, if you normally do, let's say you normally do £10,000 worth of sales, but you think you think you've got the best products and offering in the world, and let's face it, we all think we're very good at what we do, so we think everybody should want to take our services up. If you get over optimistic on that, and actually you put in £20,000, you're going to sit there and you're going to look at the end of your cash flow forecast and think, wow, this is incredible. I'm going to be rolling in it by the end of the year. But actually, it's not realistic, because you're not going to hit those targets. So you need to make sure that you're very, very realistic on your sales. I'll give you, again, an example with my client who runs the restaurant. We've got a cash flow forecast that we worked with her, and we put it together for her. And actually, we did look at increasing her sales. We increased her actual sales by 10%, and we increased, and she also had a profit, not a profit, a price increase in her products as well. It was only about a 7.5% increase in her pricing. So what we did is we made, with the cash flow forecast, we made it around about 15% increase in her sales overall. So we brought it below what we knew it would be, because she had seen throughout the course of this year a consistent 10% increase in her sales. So we based the sales numbers on the previous year and put that 10% on. We didn't put 7.5% on for the price increase. We only put 5% on. As it happens, she is smashing through the targets that we've set, because we've been realistic about setting those sales targets. So that's a very, very important thing to look at. Also, people forget to include things like their tax bills that go in and out of the business. They don't include the corporation tax. They don't include the inland revenue payments. They don't include the VAT payments. And what you have to do is you have to include all of the cash that's coming into your business and all of the cash that's going out of your business. That's the whole purpose of a cash flow forecast. So that's something that's quite important. You also have to make sure that you allocate the cash out to the correct period. Now, a great example of this is if your VAT quarter runs from January through to March, you won't be paying your VAT until the 7th of May. So you don't pay it in that particular quarter. You pay it about a month and a bit afterwards. So as a result of that, what you have to do is you have to make sure that your money is going out in the month that the cash goes out of the business. So again, that's something that you have to be aware of, rather than include it in the end of that quarter, because that's not when the money is going out. Because if you do it, then what it does is it upsets the balance of the cash flow forecast. And finally, you've got to make sure that you're realistic on your averages. It kind of speaks for itself. But again, if you're making unrealistic assumptions on what's going in and out of your business, then and unrealistic averages on what's going in and out of your business, then actually the whole balance of the cash flow forecast goes out of it. So, don't underestimate your VAT, don't underestimate your corporation tax and those things, because it will actually have a negative impact on how the cash flow forecast looks. And you want it to be a working document and a document that you can use properly. So this is an example of a cash flow forecast. So I know, Joe, you've probably seen something fairly similar to this before, because I've done it with you in the past. But what you've got here, a cash flow forecast, is you've got each month allocated, so January through to December. And what you have is in the first 3 months, you'll notice underneath the month name, I've got actual written down. And what I tend to do, and what I encourage everybody to do, is to keep their cash flow forecast as current as possible. So rather than just putting a cash flow forecast for a 12-month period and then not include and then leaving it and walking away from it, if you actually, when you get to, for example, in this example, when you get to the 1st of April, you make sure you put March's actual numbers down, because what that does is that resets the cash flow forecast every single time. It allows you to sense check the numbers that you've got in there, and it also allows you to see actually where you start, what your cash position is in the bank at the very beginning. So just to talk you through this a little bit, on the left-hand side, you'll see the small up and down arrow. That's where your sales typically sit. Now, if you've got multiple products, what you can do is you can, or services in your case, James, what you can do is you can divide your break your products down. So in my case, I've got several things that I do. I help people with sales troubleshooting. I work one-to-one with business owners in mentoring and supporting them. And I also run groups where I support people within a group environment as well. So they're effectively my three products. So on my cash flow forecast, what I've done is I've divided it into those three products. The other advantage to that is you get to see what products you offer are performing well at a glance. So you can see where you're most profitable and where you're not. Another client I work with is a solicitor, and what he has is he's a family law solicitor. He has about 5 different products or services, and we know by looking at his cash flow forecast where he gets the majority of his income from, which won't surprise you to know it's divorces, but there you go. Anyway, so that's one of the things that he does. The up and down arrow below, that's where your expenditure is. So that's everything that's going out of the business, ranging from salaries right the way through to insurances, pension, tax, and everything else, and all of the stuff in between. Now, these things are unique to you. You would change those headings to suit your own personal needs, and that's kind of what you would do. But again, it's important that you do that, and you get that information from your profit and loss account. So if you have a look on your profit and loss account, you should see most of the headings there that you can then put into your cash flow forecast. So the first thing is total sales. So this is where you add up this row here is where you essentially add up all of the sales that are being done within your business. So if you're forecasting, you may break it down. You might look at it and think, well, 20% of my income comes from this, 50% of my income comes from that, and the remaining 30% of my income comes from this product. So you could break it down into those 3 products. The total sales is then those 3 products added up, or services added up. This is the total payments or the total expenditure that you have each month. And that is, again, effectively adding up everything that you see under that long arrow. The next is quite important, the net receipts. So this is where you basically take your total payments away from your total sales, and that gives you your net receipts, which could be a positive or a negative. Now, a negative isn't always a bad thing, because there are some months where you will have massive amounts of tax that you've got to pay, or whatever it might be. You may have a subscription membership or something like that that goes out in that particular month, which can totally offset that, and it could give you a negative receipts. But it doesn't matter if you've only got 1 or 2 negative receipts during the course of a 12-month period. It's not a huge issue. But again, it allows you to see what's going on. If you have a lot of negative receipts during that course of the 12-month period, you've got 1 of 2 options. The first option is to effectively reduce your expenditure, and the second option is to increase your sales. So that's that side of it. And then the last thing is the closing bank balance. So this basically is your net receipts plus the bank balance, your opening bank balance, which gives you your closing bank balance. Now, this is your bank balance that you would have at 11:59 p.m. on the last working day of the month. So that number should be very, very close to where you're sitting on that month. And again, this is why you do the actuals, because you can tell if you've got your cash flow forecast accurate, your number should sit fairly closely to what you do see in the bank at the end of that month. What happens is with that is that gets totaled there in the closing bank balance. So that's 11:59 p.m. on the last day of the working month. And that there is 12 o'clock or midnight on the first working day of the month. So effectively what happens is that closing balance gets carried forwards, and then it's used to work out where your closing bank balance sits at the end of the end of that next month. What happens is, along here, the closing bank balance, if your cash flow forecast is accurate and if your business is running well, you should see this closing bank balance accumulate. So ideally, what you would see is that money would go up and you'd be able to see where you are. So what that does is that gives you a really good, accurate representation of where you're going to be sitting within the business. Now, I mentioned earlier on, if you were to make a purchase or something like that, you could see how it's going to affect it. So let's say, for argument's sake, what you wanted to do is you wanted to spend some marketing here in April. So what you would do is in row 20, you'd put in April, you would put how much marketing your expense is going to be. And what that would then do is that would add up here into your total payments, and you could see how it would affect your net receipts ultimately and how it would affect your closing bank balance. So that's how you sort of mess around with this and use it as a prediction tool to see how it's going to impact it. And what this does is this gives you the ability to make educated decisions rather than gut instinct decisions on what's going on within the business. So the next thing is credit control. So credit control is basically a way that you manage the money within your business. And the key word here is control, having a credit control policy. And it's making sure that you remain in control of the credit you're offering people. Sometimes when you're working with certain clients, they will ask for particular credit terms. Some people demand 30-day terms, some people demand 60-day terms, and some people demand 90-day terms. Usually the bigger the business, the longer the credit they ask for, which is for a small business, which is an absolute pain. But if you have to have an agreement with people and know, so that you know what their payment terms are, any discounts they have. We had one particular corporate client a number of years ago. They used to have something called a retrospective rebate. And basically that meant that after 12 months, they would demand 5% back against the stuff that we've done for them. Not particularly a favorable policy for a small business, but that was the price that you had to pay to work with that particular corporate. And you had to ascertain as to whether it was worth it. So going back to the cash flow forecast, what we would do is we'd plug those numbers in and we would work out whether it was worthwhile. But the credit control is something that you must do. Now, the benefits of a credit control is it reduces cash flow issues of people not paying you. So if you're on it with your credit control policy, generally speaking, you get people to pay you quicker. Your average debtor days are kept down. Now, debtor days are it's the average length of time it takes for somebody to pay you. Now, in the ideal world, you'd like to think that if you're offering 30-day credit terms, people will pay you within 30-day credit terms. However, this is not the ideal world. So what you're going to end up with often is people will take your debtor days and they will extend those debtor days as much as they possibly can. So you'll quite often have people paying you in a longer period of time. And the average debtor days, if you can get your average debtor days, if you're offering 30-day terms and you get your average debtor days below 45, you're doing quite well. But the number of people that have got their average debtor days at 60 or 60 plus days or 70 plus days is quite scary. And that just has such a huge negative impact on your business. So it's about trying to keep those average debtor days down, and it allows you to make sure that you do that. And the last thing is it stops the accounts payable department stretching out your payments, which again is what a lot of accounts payable departments try to do. So this is a credit control policy. So let's assume you're offering 30 days credit on invoices. The important thing to note here is a credit control policy starts not when your invoice is due, it starts when you issue the invoice. And that's so important, because what will happen is if you don't do it when people, if you don't start chasing invoices until those invoices are due, that's when the accounts payable department will start throwing certain things in there, like, I'm sorry, the invoice that you've sent through isn't accurate. Can you reissue the invoice? And then they'll demand another 30 days credit. And that's how they extend it out. So what you do is on day one, you invoice the client. Day 2 or 3, you contact the client to make sure that they are happy with the invoice that you've sent through. It matches the purchase order that you've done, the goods and services that you've provided. There's no problems with those. And actually, everything is okay. Now, if there are no problems, then you ask when payment will be on the invoice, when the payment of that invoice will be made, and will you be on the payment run in 30 days' time? And ideally, they should say yes. But anyway, that's something that you can do. Once you've had that yes, and you've got over any sort of other issues that may have been with the invoice. On day 20, check that you're still on that payment run for day 30. This is a crucial thing to do because this shows the accounts payable department of the company that you're dealing with that you're on the ball and you know exactly what you're doing and what you're not doing. Now, it's this whole cuckoo syndrome. The people that actually are on it are the people that get paid quicker. The people that just sit there and wait to be paid, their invoices get ignored. And the accounts payable department will pay the people who are more vocal and more persistent with wanting the payment. Day 27, double check you're on your payment run again. So you've given it another week. Just make sure, give the accounts payable person another call to make sure that you're still on there and there are no further delays. And then day 30, you should get paid. Now, if you haven't been paid on day 30, what you've got to do then is contact them straight away and find out why you've not been paid and then ask to reschedule the payment. Now, it's really, really important that you do this during that period where the credit is still live rather than when it's due. Because if you go through this period when it's due, then you can see how much it will be stretched out and that will delay you getting paid. And that's not what we want. And as long as everybody knows what the payment terms are and your communication is there and everything else, this really, really does help. There are a number of companies out there that offer credit control facilities for your business. If you feel uncomfortable doing that yourself because they are your client, then it's often good to engage with a credit control supplier who will do that on your behalf because they don't have the emotional attachment to those clients that you may do. The last thing I want to cover, and then we'll take some questions after that, after this one, is about cash management. Now, this is an amazing book. And if you've not read this book, then I suggest you have a look at it because it's a very, very good book of how to manage your money within your business. And it's a book called Profit First by a guy called Mike Mikhailovitz. I hope I pronounced that correctly. But basically, what this book does is it looks at how you manage your money properly within the business. And this is how it does it. If you don't want to read the book, this is the shortcut to it. So the first thing is total income, including your VAT. This is all of the money that comes into your business. So 100% of your income plus the 20% additional cost of your VAT. So what you do is you create separate pots. So you create 5 pots for your business. The first pot is a VAT pot. So that's where you take 20% of that income because that income isn't yours and you put that into the VAT pot. The second pot is your operational expenditure. Now, in a typical world, your operational expenses will probably be somewhere in the region of about 30% of your turnover. So what you do is you put all of those operational expenses into that second pot. So you take 30% of that money and then you put it into your operational pot. The next one is your tax pot. So this is your corporation tax. Generally speaking, corporation tax is around about 15% when you equal it all out. So what you do is you take 15% of that money and then you have that total income and you put that into your tax pot. Then you've got your salaries. This could be, if you're working in the business for yourself, this could be your own salaries, or sometimes it can be the salaries of your staff as well. And you create a salaries pot. And you know the proportion of your income that you spend on salaries and everything else. Generally speaking, it's around about 50%. If you put 50% in there, you'll cover your salaries and that side of things. And the last pot is profit. And it's about saving yourself into profit. So take 5% of your income and then allocate that into your profit pot. Now, what that does is that means that you've got 3 pots there that are just going to continually build. The first pot being your VAT pot, because what happens with VAT is you offset your VAT you're paying on the things that you're buying against the invoices that you're making. And generally speaking, you're going to be looking at about 13, 14%, something like that is actually what you're going to be paying in VAT. So that'll give you an additional sort of 6 or 7% that will build up within that period. And then over a 12-month period, what you'll find is you'll be the money that you've got sat in your VAT account, you'll have that money there each quarter before the quarter actually finishes, before the quarter even starts. So it allows you to build up a decent hefty lump in your VAT pot. The second one is that's going to build up is your tax pot. So again, accountants, what they do is they can do some clever stuff with your accounts. And as a result of that, they might be able to save some money, offset some stuff that you're paying against tax. So you might have made some charitable donations. You may have been paying, you may have been able to pay yourself some money into your pension scheme, which is also tax-free. So there are certain things that an accountant might do and will reduce that the amount of tax that you pay down. And if you do that, then actually that money in that account is going to build up as well. And then obviously the last one is profit. Profit will build up over time. If you're putting 5% of your income into profit every single month, then that will build up and that will help. So that's kind of like a very, very quick overview of 3 things that you need to use and you need to do within the whole cash flow management side of things. Has anybody got any questions on any of those things?
Yeah, just a quick question. On the credit control and debtor days and all that sort of stuff,
Yes.
and following up invoices, my sort of experience has been that companies have a payment date, so they'll run their uh, paying invoices on the 25th of the month or something like that.
Uh-huh.
But that is not contingent upon when you actually issue your own. I issue my invoice
Yeah.
to them. So,
How do you get
any
around that?
advice or thinking about that?
Yeah, absolutely. So one of the best questions you can ask them, James, is when is your payment run date?
Yeah,
So if they say to you it's the 25th of your month, 25th of
yeah,
the month, then what you can do is you can submit your invoice to them on the 25th of the previous month.
yeah,
So it sits in with that 30-day process.
yeah, yeah.
So that's one way around that. Now,
Mm,
what will happen is the accounts payable will tell you when the payment date is,
mm,
because they're fairly open with that, and it's
yeah,
not a secret or anything like that.
yeah,
So what you do is you structure your invoicing around that payment date, so get
yeah.
strategic with it yourself. Because
Hmm.
if you, I know what it's like.
Mm,
If you're offering 30-day credit terms and you send your invoice through on the first of the month, they've
mm,
got all of that month or
yeah,
25 days of that month.
yeah,
They're still within credit at the end of that month, and then they
yeah,
stretch it out to the 25th of the following month. So
yeah,
all of a
yeah,
sudden you've got 60 days worth of credit you're giving somebody, or 55 days worth of credit you're giving somebody when your terms are 30 days in your agreement.
yeah, yeah, yeah,
So
yeah, yeah.
invoice them before the 25th of the previous month if you're offering
Hmm.
30 days. It also can come down to the negotiation element to them when you start as well, because it might be that your payment terms are 7 days. They may agree to your payment terms being 7 days. Um, but it's making sure that basically where you sit is you invoice that invoice to them
Yeah,
at least your payment terms before the length of time your payment terms are before their payment date is.
yeah, yeah. No, fine. Okay. No, thank you very much. Yeah, yeah. Because, I mean, the 2 instances you've quoted there, the 30-day stuff and you can miss out and it's 2 months really rather than you get paid not 1 month later or whatever. And yeah, there are times when, because the nature of the nature of the project work, and I might be dealing directly with the MD of a small business, and they'll say, well, if your terms are 7 days, then yeah, we'll abide by that. But it's sort of you have to chivvy them up again. But it's about
Absolutely do.
it's like, but like you're saying, it's been about it's sort of, and this is well, you've kind of indicated this, being brave enough to sort of say this is what we want to work to, and I'll work to that. We know what we're going to do, and we'll do that, rather than it flipping about in the sea, as it were.
Absolutely. And
Yeah.
what I often say to people as well is um, a client supplier relationship is a relationship. It's a two-way
Mm,
thing.
mm,
And if they want you to do the job that you're doing for them, they've
mm.
got to respect you as the supplier.
Yeah.
And actually, a lot of businesses, the attitude, particularly in this country, you can't get away with this in Germany, for example, but the attitude in this country is you can do the services and then we'll stretch out the payment as long as we possibly can. But
Yeah.
actually,
Yeah.
what that's doing is that's impacting you personally.
Mm,
So when I've actually got a policy now where I'm very particular about the types of people that I work with. Um, it makes a lot of people laugh. I call it my I don't work with dickheads policy. And essentially what I do is I just make sure that I vet everybody that I work with.
Yeah,
Now, I'm not going to lie, you know, sometimes I work with people and they struggle to pay at particular times. It's the
yeah.
nature of what I do. It's the nature of the types of people that I work with.
Mm,
But there's always that communication element going on. And I always
yeah,
know where that situation is. So what happens is my clients don't take the mickey with me, but
yeah.
what they do is because they know I know their particular position.
Mm,
And I then, if they are struggling to pay me on a monthly basis, I then break it down and they pay me on a they pay me sort of increments throughout the course of the month rather than
sure.
paying me one
Yeah.
massive lump sum. So you can be flexible with these people.
Mm.
What it is, it's about you're showing willing to be flexible with them, but it is about getting your money out of them.
Yeah, 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 yeah. Because it's sometimes if you're working personally, I mean, if you're buying components to make fridges with or whatever, and it's just a transaction. But like the sort of work I'm doing, I'm actually reporting, maybe often reporting back to the MD, and it's you having a dialogue with them about what the project is about, and then. And you don't want to upset them and say, "Can I have the money, please?" It's that kind of. Well, you've
Yeah.
seen that. Thank
Another
you. Yeah,
thing,
yeah. Thank you.
another thing you could potentially do
Mm.
is you could turn around to them and change your payment terms. So you could say 50% upfront and 50% on completion of the project.
Yeah,
And
yeah,
that's
yeah,
another way of doing it. So then
yeah,
you're not out of pocket. You're not working for nothing for the first sort of few months.
yeah. This is,
What you've
this
got
is,
what
yeah.
you've got to
Sorry.
remember is you are captain of your ship
Mm,
and you are in charge of your ship. And
yeah,
if you set your payment terms out and that particular client isn't willing to go down your payment terms, then you've got to ask yourself why that's the case. Now,
yeah,
sometimes they'll just give you a blanket, well, that's not the way we operate.
yeah,
You might turn around to them and go, well, that's the way I operate.
yeah, yeah,
And it's just one of those things
yeah,
that can
yeah.
that can sort of affect stuff.
Well, that's it. Yeah, no, no. Thank you. It's good to hear that. I mean, I've seen those situations in various formats, but it's good to hear it from somebody else who's not sitting in that,
Yeah.
dialogue. Is it
Oh,
a
yeah,
live
it is a
dialogue?
nightmare. It is a
Yeah.
nightmare.
Thank you. Yeah. Thanks very much.
Joe, did you have a question? You look like you might have had a question.
Yes, I was actually wondering how would you approach, because you said in the how to manage creditors that you would follow up with 20 or 27 days, like phone call to find out if the payment is going to come through at the particular time.
Mhm.
But how to approach it if the customer's saying, no, we can't pay that on time?
So when can you pay it is the next question.
So then it's the moment when you would go into kind of arrangement plan then.
Absolutely. Yeah. So it's very much a case of, okay, so you can't pay me on the required date that you said you were going to pay me on. So when can you pay me on? And if they say, well, we don't know, then I would say probably something along the lines of, okay, well, let's enter into an arrangement then. So let's say it's £1,000 that they owe you, and you're at day 20, and they've turned around to you and said, sorry, we can't pay you on day 30. You say, well, okay, well, how about you pay me £250 a week for the next 4 weeks, and we clear it that way, and then go down that route. There is something that you can do after that as well. If somebody isn't paying you, you can have something called a letter before action, which seems quite harsh when you're running the business and you sit there and you think, well, these are my clients and I don't want to have to chase them up too quickly and be too forceful with them. But what I say to everybody is a client isn't a client until they pay you the money.
Mhm.
And we had this situation in 2012. It was actually the situation that put us out of business. We were factoring our sales ledger, so we had the money coming into the business because we were getting it loaned to us on invoices that we did, but we weren't on it with chasing the client. And what happened was the client went under, owing us 3 weeks worth of cash flow. So as a result of that, the factoring company then took the money away from us, and we had nothing to pay our suppliers with. We had nothing to pay our staff with. We had nothing to pay our bills with, basically, and arrangements that we had with the tax man and everything else, purely because this client let us down. Now, had we been on the ball with it and actually turned around to them and said, well, here you go, and you need to be paying us. And after 30 days, we'd have gone, right, let's go into a payment schedule. We would have ridden that out, but we didn't. So it's very much what you don't want to do is you're not bankrolling these people. You're providing a service for these people. So these people should pay you. And what you've got to be aware of is you don't want to be bankrolling them. And what happens is larger companies tend to take advantage of smaller companies because they know you're desperate for the work. They know you really want to be working with them. They know that. So as a result of that, they try to dictate to you what they're going to pay you and when they're going to pay you. What you have to do is you have to be more, I wouldn't say forceful. Forceful's too strong. I would say more deliberate is probably the way to describe it about when you're going to be getting paid. And actually, then you do that. And then you've got to also be prepared to remove your services from them. The mistake we made was we continued working for this company. We knew they hadn't paid us. We assumed they were going to pay us, but they never did. And we just carried on working for them. And we were busy fools because we were working for nothing, which eventually put us out of business. So that's why it's so important that you do that. And if you're talking to them on a regular basis and you know what their situation is and when they're going to pay you, then you know what it is. If you know there's a delay, great. You know there's a delay. You can actually deal with that. Like I say, credit control is about you being in control. It's not about your client being in control. And that's the important thing that you've got to bear in mind. It's about retaining that control yourself.
So it's a kind of like a very actually important step.
Oh, hugely,
Really,
hugely. Yeah,
really take a toll on the business.
yeah. Yeah, if you do those three things together, a cash flow forecast, credit control policy, and cash management, if you have all of those three things together, then what that will do is that will give you a much more control over the business in general, a much more educated position of where the finances are sat within the business.
Yeah, thank you very much.
No problem at all. Any other questions or anything like that? No worries. Okay, cool. So what we'll do is I just want to sort of like finish this off now. So these are the three things that I do. The first thing I do is sales. I help people with sales processes, sales forecasting, sales training, and also sales troubleshooting as well. So understanding where people are sitting within the sales side of things. I run some group sessions that I call Peer Power, and those sessions are very much around getting a group of small business owners into a room, discussing fundamental business skills that can put the foundation down for the business, and helping them in that respect. And then you get the support within the room, the peers, and hence the name Peer Power. And then the last thing I do is I work with people one-to-one as well, and mentor people in a one-to-one process to help them do that. And they're my contact details as well. Obviously, you're connected with me on LinkedIn, which is fantastic, and you'll see sort of stuff that's going up on LinkedIn. But if anybody wants to have a one-to-one with me, I'm more than happy to have a one-to-one. And it'd be good to sort of, firstly, it'd be good to catch up, Joe, because it's been a while. And James as well. It'd be good to have a one-to-one with you and get to understand actually what you're doing and get more of an understanding of that side of things as well.
Yeah, thank you.
So it'd be good to do that. But yeah, so if you do have any other questions, you want to take that offline, then brilliant. If you would like to have a one-to-one, I'd love to have a one-to-one with you. And if you've got any other questions and you want to stay on the call just to ask any other questions, then I'm happy to do that. And what I shall do is I shall stop the recording. If I can find where to stop the recording. There we go.